Howdy, everybody. Welcome to Liberty Call. Today is Friday, May 23rd, 2025. Hope you're having a fantastical day out there in the interwebs. It's kind of gloomy here in Colorado. It was sunny this morning, but now it's gotten all gloomy outside. So that's not good. So hopefully you're having a fantastical day out there in the interwebs. And markets ended the week in the red as Trump's fresh tariff threats rattled investors. A 50% hit on EU imports and a 25% slap on foreign assembled smartphones sent tech reeling. Apple dropped nearly 3%. Nuclear stocks surged on word of Trump's support, while Intuit soared and Deckers sank on earnings. With oil wobbling and holiday volume thin, Wall Street is headed into the weekend on edge. So before we break down all the excellent news that I have put together for you today, I need some help from you. Yes, you. I see you sitting there, Bob, Jim, whoever you are. I see you in that red shirt. Give me some thumbs up, like and share, subscribe, and follow, and press that darn notification bell. All righty, well, let's get into today's markets. Dow Jones finished the day down 0.61%, 256 points, closed at 41,603. The S&P 500 down 0.67%, 39 points, closed at 5802. NASDAQ down 1% even, 188 points, closed at 18,737. The VIX was up 9.91% today. It's at 22.29. Canada up 0.1%, Brazil up 0.4%, and Mexico up 0.89. Headed to Europe, Germany down 1.54%, the UK down 0.24%, France down 1.65%, the Netherlands down 1.03%, Spain down 1.18%, Italy down 1.94%, Switzerland down 0.63%, and Portugal down 0.61%. Russian exchanges also red today. The MOEX down 0.75%, RTSI down 0.72%. And the overnight markets, the Nikkei in Japan was up 0.47%, Australia up 0.15%, New Zealand down 0.21%. In China, the Shanghai down 0.94%, Shenzhen Component down 0.85%, China A50 down 0.84%, DJ Shanghai down 0.91%, Hang Seng up 0.24%, and the Taiwan weighted when it closed on the 22nd was down 0.61%. All right, so those are the markets. Let's bring up our chart and see how we did for the week. All right, let's take off our lines, go to the week. There we are. All righty, starting out with the Dow Jones. We're going to finish in the red by about 2.02%. The S&P 500 is going to finish off down about 2.59%. The NASDAQ down about 2.49%. The Dow Transports down 3.98%. And the Dow Utilities, looks like the best of all of them, only down 0.69%. So rough week for the markets. It is what it is, unfortunately, but let's zoom out and take a look and see how things are kind of shaping up right now. This right here was the beginning of the year, right here where the vertical line is. So we've had a nice uptrend. We've had a downtrend for about 2 months, February and March. April was an uptrend, and then we've had a bit of a downtrend here this last week. So we'll see what happens. I mean, we keep breaking, let me put my trend lines back in. We keep breaking these trend lines, but we never get any real long-term action. It's fairly short-lived and aren't really going anywhere here the last 6-7 months. So, all right. Well, that is that. So let's get that off the screen. What do we want to get to next? Economic data. Yep, that's what I thought. Starting out with initial jobless claims, they came in at 227,000. The forecast was 230. Previous number was 229. Continuing claims came in at 1.903. Forecast was 1.89 million. Previous number 1.867. So it creeped up by about 36,000, looks like. The leading U.S. leading economic index came in month over month, down 1%. Forecast was down 0.7. Previous number was a negative 0.8. Existing home sale. Well, did I skip something? Nope, I did. Existing home sales came in at 4 million. below the 4.15 million forecast. Previous number was a 4.02 million. Month over month, existing home sales contracted by 0.5%. Previous number was a contraction of 5.9%. The Services Purchasing Managers Index came in at 52.3. Forecast was 51. Previous number 50.8. And the Managing Purchasing Managers Index came in at 52.3. Forecast 49.9. Previous number 50.2. Federal Reserve balance sheet is at 6.689. Is that billion or trillion? I think it's trillion. And previous number was 6.713 trillion. So it is it's slowly going down. New home sales came in at 743,000, forecast 694, previous number 670. And on a month-on-month number, it grew by 10.9%. Previous number was 2.6% growth. All right, so that's all the economic data for the week. It was kind of a light week for data. Let's jump to the market recap. S&P 500 ends the week lower as fresh trade war fears bite. The S&P 500 ended Friday under pressure despite trimming earlier losses as President Donald Trump rekindled trade fears by recommending a sweeping 50% tariff on all European Union goods starting June 1st. Trump accused the EU of exploiting the U.S. on trade, citing stalled negotiations. Previous tariffs, 25% on EU cars, steel, and aluminum, and 20% on other goods, had temporarily halved during the 90-day negotiation window, now at risk of a collapse. The EU had responded by proposing zero industrial tariffs on both sides, but Trump's latest threat derailed that progress. Adding to investor anxiety, Trump also threatened Apple, proposing a 25% tariff on iPhones not made in the U.S., sending Apple stock sharply lower. Meanwhile, the U.S. House of Representatives narrowly passed Trump's controversial tax cut and spending bill, despite concerns over its impact on the already $36.2 trillion federal debt. The Congressional Budget Office estimates it will add $3.8 trillion more over the next decade. Does that include the interest that we're gaining $3 trillion a year right now? Treasury yields rose and demand for government bonds weakened. I wonder why. Federal Reserve Governor Christopher Waller offered some relief, suggesting rate cuts could begin later this year if tariffs are reduced to 10% and a deal is finalized by July. In corporate news, Tesla was edged out by China's BYD as the top EV seller in Europe, despite EU tariffs on Chinese imports. Retailers Ross Stores and Deckers Outdoor both issued weak forecasts due to tariff concerns and economic uncertainty, while Intuit stock soared after the firm raised guidance on a strong tax season demand for TurboTax and QuickBooks. The Supreme Court ruling also gave markets a boost by confirming the Federal Reserve's institutional independence, ruling out the possibility of Trump firing Fed Chair Jerome Powell. Overall trade tensions, debt worries, and mixed earnings weighed heavily on investor sentiment heading into the weekend. It's a 3-day weekend, folks. What are y'all going to do? I'm going to watch a lot of baseball. That's just what I enjoy doing. Probably going to do some yard work too. We got so much rain. It's all the grass is getting all high along the sides of the driveway and out in the ditch near the street. So, excuse me. All right, got a data report here. April new home sales from First Trust. Mr. Bryce Gill put this report together. So let's see what it has to say. New home sales surged in April, posting the largest monthly increase in nearly 2 years and beating expectations. Annualized sales reached 743,000, marking the fastest pace since 2022 and slightly exceeding pre-pandemic levels. Gains were widespread across regions, with only the Northeast seeing a decline. Despite high mortgage rates, 30-year fixed loans are near 7%. The housing market saw momentum without support from additional Fed rate cuts. Median new home sales have dropped 2% year over year and are down 11.5% from their October 22 peak. The median size of a new single-family home has shrunk 5.6% since Q3 of 22, contributing to lower overall prices. However, this also reflects a price per square foot decline, suggesting developers are using incentives to move inventory. Supply has also played a significant role. The number of completed single-family homes available for sale is up more than 270% from the low in 2022. This stands in contrast to the existing home market, where inventory remains tight due to homeowners staying put in low rate mortgages obtained during the pandemic. Looking ahead, lower home prices and ample inventory are expected to support continued strength in new home sales through 2025. Meanwhile, the Kansas City Fed Manufacturing Index inched up to -3 in May, reflecting ongoing weakness in the factory sector. Well, that's awesome news. All righty. So new home sales are doing okay. Existing home sales are kind of simply because a lot of people have mortgages with interest rates probably below 5, and they're wanting to hold on to them. I can't blame them. My interest rate is I think 3.5, something like that. Got it back in 2017 when rates were they weren't as low as they were during the pandemic, but they were still pretty low. All right, got one more article that we're going to cover for today from Zero Hedge. Here are 6 signs the housing market depression in the U.S. is getting even worse. This was written by Michael Snyder of the Economic Collapse blog. So let's see what Michael has to say. The U.S. housing market is slipping deeper into a prolonged downturn with clear signs of a worsening housing depression. High interest rates and unaffordable home prices have sidelined millions of potential buyers, causing home sales to remain at severely depressed levels. In April, sales of previously owned homes fell to a seasonally adjusted annual rate of 4 million, the slowest April since 2009, despite the U.S. population growing by 34 million since then. Alarmingly, this decline occurred even as active listings and new listings hit multi-year highs, suggesting growing supply is not meeting sufficient demand. Affordability issues are especially acute for young buyers. The average age of U.S. home buyers has hit a record 56, while median age of first-time home buyers has risen to 38 years old. Wow. First-time buyer participation is now at its lowest level since the National Association of Realtors began tracking this metric back in 1981. Meanwhile, Zillow reports home sales have declined in 27 states so far this year, with key markets like Florida and California seeing notable drops. Rising layoffs, such as Walmart's 1,500 corporate jobs cut, add further pressure to a fragile market. Mounting financial stress, now affecting 70% of Americans, is driven largely by unaffordable housing. Unless interest rates drop significantly, the market risks a broader correction akin to the 2008 financial crisis. Wouldn't shock me. I really wouldn't be surprised to see home prices, reassess or recalibrate based on the current market, but we shall see. It's a little too early to tell. All right, well, that is everything that I had to cover for today. So if anyone needs to get in touch with this guy, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a call. I'll be glad to help. All right, well, hope everyone out there has a terrifical long weekend. I might do a video on Monday. Probably not. I'll probably do it on Tuesday, but I'll be here since I work from my house. And so it doesn't take much effort to walk downstairs. So I will try to do some stuff on Monday. I can't guarantee it. The wife may have some honeydews for me. So, all righty. Well, hope everyone out there has a awesome weekend, and I'll talk to everyone again next time.